Welcome to today's edition of the Statler Financial Radio Show. Your financial security is our business. Have a question for the team? Call today, 863-877-1188. That's 863-877-1188.
Welcome to the Statler Financial Radio Show. I'm Stephanie Griffin, and this is our July 4th episode, which means we're talking about independence. And not just the kind of the country declared 250 years ago, but financial independence in your life. For retirees and those approaching retirement, that phrase means more than just the day you stop working. It's the day you stop guessing, stop reacting, stop worrying about whether your money will hold up, and start living the way you want to live. But before we get into the show, if you're ready to declare your financial independence today, all you have to do is give us a call at 863-877-1188 to meet with Philip Statler. He is our founder and president of Statler Financial Group. That number again is 863-877-1188. Hello, Philip. I can't believe our country is 250 years old.
Yeah, it is. Well, it is hard to believe that. I think back to 50 years ago, our 200th birthday.
Yes. Seemed like
Yeah, that was, you probably weren't even alive then.
I
were you?
was.
Yes.
I was 6 years old.
So I remember back, I remember, you had the bicentennial coins that came out and all the hoopla, that 4th of July. It was an exciting time in our country.
Very much.
And unfortunately, I don't know that we see quite the excitement this year that we have seen in the past.
I don't think
We've become so divided as a country, which is not good. But it still goes to the fact that independence is independence. And as we head into retirement, independence is important on a few fronts, right? I mean, we want to be independent as retirees. You should be working with somebody who is independent as a financial firm who doesn't have to take direction from the big guys upstairs that promote more profit than well-being. And that's truly what independence means in our business. And so there's several fronts we want independence on.
So let's talk about how we can find true financial independence. So why do so many people with some nice size savings, feel financially uncertain heading into retirement?
Well, I think that a large portfolio sounds really good and exciting.
Mm-hmm.
And for people that don't have one, think it's great that somebody has a large portfolio, that they are on easy street. They don't have to worry about anything. But that large portfolio, Stephanie, without having a plan in place, still produces anxiety. It still makes people anxious. They're not sure. Is it really enough to get me through? They don't know. And that's where having a plan in place really comes handy, right? Because if I have that plan, I can see it on paper. I can see how the math works. I can poke holes in it and go back to, talk through it with my advisor and say, hey, look, what if this, what if that, what if this happens? And we can now put our eyes on it, and that helps reduce that anxiety level. So that's number one. Two, accumulating wealth and designing income are two very different skills. And not every financial advisor has both skills. I would go out on a limb and say that you pretty much have one or the other. Either you're an accumulator or you're an income planner. And they're that different. There's that much of a divergence between the two. And if you continue to work with a wealth accumulator in the retirement years, you are going to see a huge amount of volatility within your portfolio. Working with somebody that knows and has designed income as their main focus is a totally different mindset. And then most people, Stephanie, they plan to retire, but never plan for retirement itself. And that's big. And that goes back again to the whole planning thing. We
Right.
need to have a plan in place.
Very much so. Very a big part of it for sure. Let's look at the first principle of financial independence. The idea that retirement should be designed and not, what do you say, like drifted into. So, what actually does that mean to design a retirement before it arrives, which you do at Statler Financial?
Absolutely. It means that we have to, we've got to be shifting from growing our money to more of a coordinating our money. And I will tell you, 70, that is easy to talk about and it sounds easy to do, but for the average retiree, it is very difficult to move from I want to make 12, 15, 20% of my money
Mhm.
to I want to make sure my money lasts throughout my lifetime. It is two totally different ways of managing money. Then you've got income, taxes, and spending. All need some kind of blueprint before day one of retirement. So you know what those numbers are going to be in retirement. What is my income going to be in retirement? What are my expenses? What's my tax bill going to be? Because believe me, even in retirement, Uncle Sam's going to be there with his hands out. And then purpose and structure have to come before the resignation letter. Now, what do I mean? I mean that one, you need some purpose within your retirement. What are you going to do? What's going to be your purpose? Your purpose for the last 20 or 30 or 40 years has been to get up, get dressed, and go to work.
Right.
Bring home the bacon, right? That was the deal. You brought home the bacon. Um, so now you're retired. You're not going to have to do that every day. So what's your structure going to look like? Those type of things. Those are important things, definitely, that people truly do not think about before they retire. And it's a conversation they need to have with their spouse, with their self, to make sure they know where they are and what they're going to be doing in retirement.
Definitely. And it's important to know, and Philip Statler can help you do that. So give him a call, 863-877-1188. 863-877-1188. Let's talk timing. Someone who is considering retirement 2026 or 2027 is weighing a number of factors. They're thinking pay raises, inflation, market volatility, policy shifts, all those things. Each of those can make a big difference. Why does the year someone retires matter so much financially, Philip?
Well, think about it. One more year of peak earnings can permanently raise your pension if you get a pension. It can raise your Social Security. Everything could get a benefit from that. So one more year of good earnings, peak earnings, is good for everything. Retiring into a down market, on the other hand, without a plan, can accelerate portfolio depletion. And that's not a good thing. And that's why you want to have a plan in place before you retire. And the timing of your exit really shapes your income foundation for decades. We say the 5 years before you retire and the 5 years after you retire are vitally important, because what happens in the market and how you handle it and how you have things set up can drastically affect your income and how long your money is going to last through retirement.
Now, inflation, that's kind of a scary thing for a lot of people. For someone who has built a real wealth, why is inflation still a serious threat, even if you have significant assets in play?
Inflation, it takes away purchasing power. It shrinks what your dollars will buy. And year after year, it just starts knocking down the value of your dollar and what you're going to be able to use it for. Cost of living adjustments often help, but they never fully take the impact of inflation away. They always trail the actual retiree expenses. And then a strong income plan has to be built to outpace inflation, not just survive it. Stephanie, that's the way it is. And listen, independence isn't something that just happens to you. It's something you make happen for yourself and for the people you love. Listen, if you've saved at least 250,000, 500, a million or more, heading into retirement, now is exactly the right time to take control. Call Statler Financial today for a complimentary. We'll sit down and make sure that you are on the right path to that retirement you always dreamed of. We'll look at your income, your expenses, what you've done so far. What do you need to do? Give us a call, 863-877-1188. That's 863-877-1188. I'd love to spend 30 minutes with you to make sure that you are doing what needs to happen for your retirement.
We only have about a minute left. Policy uncertainty, though, is the other major concern. Changes in tax law, Social Security, healthcare rules. How do you plan around something that is unpredictable?
Well, you're right. You can't predict policy, but you can build flexibility into your plan. So by scenario planning, what if taxes rise? What if benefits change? What if this happens or that happens? It creates real options that we can see in black and white and realize what we would do, what triggers we would pull, what things would change or have to change if those things happen. Diversified income sources can help reduce the damage that any single policy shift can cause, Stephanie. And we don't know what they are or what they're going to be. And I know it's always concerning to folks.
Financial independence isn't an accident, it's a declaration. Make yours today. Give Philip a call at 863-877-1188 to schedule your complimentary visit. That's 863-877-1188. Happy 4th of July, everybody, and we will be right back. Turn your plans of yesterday into yes today. Don't wait another day for a routine checkup of your retirement plans. Call Statler Financial Services, 863-285-3815. That's 863-285-3815.
Happy 250th birthday, America. You don't look a day over 120. Ooh. Kind of sounded better in my head. Anyway, happy Independence Day, America.
Many people don't plan for long-term care until they have to. But long-term care isn't just nursing homes. It can include in-home care, assisted living, or ongoing support over time, and those costs often aren't covered by Medicare. That's why Statler Financial Services helps clients plan ahead, looking at how long-term care fits into a broader retirement strategy. Planning ahead is not about expecting the worst. It's about understanding your options. Call Philip Statler at Statler Financial Services today at 863-877-1188. Philip and his team offer guidance to clarify your choices and cost before you need to act, no matter what life brings. Now is the time to learn more. Call Statler Financial at 863-877-1188, or you can text VISIT to 863-877-1188.
Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Welcome back to the Statler Financial Radio Show with founder and president Philip Statler. I'm Stephanie Griffin. Thank you so much for listening today. Market volatility isn't a question of if, but when. But here's the truth. With the right preparation, market corrections don't have to derail your financial future. Philip, let's get started with fundamentals. Why should every investor, regardless of their age or portfolio size, have a plan in place for market volatility before it happens?
Well, I think a couple of things. One is, I think you said it just a minute ago, it's not, if it happens, it's when it happens, because we know historically it's going to happen. We just don't know when. So a couple of things that we need to make sure that we are ready when it does happen. Emotional decisions during downturns can be wealth destroyers. We saw that in 2008, where people bailed. When we call it capitulation. That's when everybody starts bailing out of the market instead of holding tight because they just can't stomach it anymore. So emotionally, you need to make sure that you've got that tied down. How much are you willing to hang in there? Corrections happen on a regular basis. Now, correction is when the market drops by 10% or more, but less than 20%. 20% or more, we start to call that a bear market. It's more than a correction. So that they're going to happen on a regular basis. And so having a plan helps eliminate those panic-driven mistakes. And that's where having that retirement income plan in place, knowing where your income is going to come from, and making sure that it is a little bit more protected than the rest of your accounts goes a long way to helping you weather those storms. So preparation allows you to see opportunities too, not just the threats that come when the market declines.
And if you'd like to talk to Philip about your portfolio, you can do that by calling 863-877-1188. That's 863-877-1188. And yeah, we've seen it happen. We've all seen it happen. Investors who seem to have everything figured out suddenly make devastating mistakes when markets get rocky. So what are some of the most common and costly errors you see people make when they haven't properly prepared for market volatility?
Selling at the bottom to, quote, stop the bleeding. At that point, if you're at the bottom, you might as well ride it out. A caveat, right? As long as you've got a well-diversified portfolio. Now, if you're in all, penny stocks or something that's very, very risky, well, that's a different story. I'm talking about people that have a well-rounded, a well-balanced portfolio. Then those companies are good, solid companies. They're going to weather the storms like they have for years. So that's one. Moving everything to cash and missing the recovery. I got to tell you, I saw this last year. Stephanie, I had a client come in and say, look, I'm concerned about the election. I'm concerned about what's going to happen. I want to get out of the market. I want to go to cash.
Oh, wow.
I said, oh, okay. So I let him think about it for a little while, and I gave him a couple other scenarios. Mm-hmm. Why don't we liquidate half and leave half invested? Well, he called me back and said, no, we talked about it. We just want to liquidate everything. Let's put it in money market. Let's see what happens with the election. And what happened? The election hit, markets bounce, and it's tough to get back in to the marketplace. So just an example of where we see it happen. Abandoning your diversification. Like I said earlier, all this relies on having diversification within your accounts. And that's a big deal. And then letting fear override your long-term strategy. The younger you are, the easier this is because you got a lot of time left. The closer you get to retirement, that's why we need to start making adjustments to what our accounts look like before we get to retirement. I would say 5 years before retirement, we need to start looking at those accounts and making adjustments so that we don't have too much risk in there for retirement time.
Well, some investors think they can actually wait until they see trouble coming and then make adjustments. I don't know about you, Philip, but I don't know how to time the market. And I know that's pretty difficult. So what makes it so challenging to predict when volatility will strike or when stocks will go higher? And why is waiting until it happens such a risky strategy?
Here's the deal. Nobody knows, what the market's an emotional machine. A lot of times it's emotion that drives the market. Yes, the traders out there, the people that do this for a living, they're looking at, either charts or technical analysis or fundamental analysis or all those things. But you can throw those things out the window when emotions hit. And so we don't know when the next thing's going to happen. Right. And just because the markets are down doesn't mean the stocks in your portfolio down. You may have stocks that are, counterproductive. They may go the other direction. So you just don't know. Just because the market's down doesn't mean your account's going down. I see that all the time. And so you just need that to make sure it comes down to those couple things, Stephanie, making sure that the risk in your portfolio overall matches up with the risk you can handle. And we saw this back in 2008, where people thought they were a moderate investor. Unfortunately, a moderate portfolio back then lost 15 to 20%. That was way more than the moderate investor thought they could lose. And so they figured out real quick they weren't really moderate investors. The problem is they found out too late. We want to find out ahead of time what kind of investor you are so that we can pick the right kind of portfolio. And that helps with that whole process.
You were listening to the Statler Financial Radio Show. You can go to his website, statlerfinancial.com, find out more about the services that they have, and you can also give them a call, 863-877-1188. Sit down with Philip, talk to him, have that free consultation, 863-877-1188. Now, Philip, you've helped a lot of clients prepare for and navigate through various market cycles. For someone watching who's thinking, I know I should prepare, but I don't know where to start, how do you help people build a comprehensive volatility preparation plan? That's a mouthful.
Well, that is a mouthful, and but it's a good point to make. And I guess really, Stephanie, it starts with understanding the amount of risk you can handle. And we've got a couple tools that we use here at Statler Financial to help us ascertain what that number is for you on a scale of 1 to 100. What does that look like for you? And so we plug that into our system and build our portfolios around that. And we can show you, look, based on your risk number, if we had another 2008, here's what it would look like for your portfolio versus what your current portfolio looks like. If another 2008 happens, here's what your current portfolio would look like. So sometimes that helps people understand what the differences are between different portfolios by, when we run those big booming situations, what could happen. And so that really helps them get a better picture of risk and how it affects their portfolio.
Since every investor has unique circumstances, risk tolerances, and goals, can you walk us through the kind of personalized volatility assessment you can provide for clients?
Absolutely. And that's really our core retirement design, Stephanie, is that process where we'll sit down with folks and make sure and actually run a risk analysis on their current portfolio to see, okay, what is the risk in that portfolio on a scale of 1 to 100? We run you through an analysis to determine what your risk score should be. And then we compare the two. If your risk number is a 52 and your current portfolio is at 75, well, there's a big mismatch there. And so we need to make sure that we get on the same page, that our portfolio and our risk tolerance are on the same page. And that's really what we strive to do here at Statler Financial.
Philip, can you walk us through the process at Statler Financial Services and tell us a little bit more about that?
Absolutely, Stephanie. So we start with a no obligation, a 30-minute phone call. That 30-minute phone call is really where you can ask us questions. We'll ask you questions. We want to see where you are and what your ultimate goals are. And if you're on the right path to get there, God bless you. We're going to let you know that, or we're going to encourage you to do a couple things and set you on your way. If I see a place where I think I can help you, I'm going to let you know that. Hey, look, I think that we could help here, or I think you're off track there. And then we would sit down together in the office and go over, or by Zoom. I can do Zoom meetings too. And we'll go over where you are and collect the data that we need, statements, tax returns, all those things to put together a financial plan for you. And by doing that, then our next step really is we get to work and we run the risk analysis on your current portfolios. We also then get what your risk assessment looks like. From there, we look at the fees and expenses you're paying inside of there. We move on to taxes. We prepare a tax plan and see, if there's any opportunity for you to be saving in the area of taxation. And when I say saving, I don't mean saving just for today, but I want to save you a lot of money over your retirement lifetime. And so sometimes, Stephanie, that means we pay a little bit more tax today and tomorrow, in order to live tax-free the rest of our retirement. So that's the second leg of our planning process. The third leg is putting together that income plan, showing you where the income's going to come from, how we're going to get the income we need. And then the big number is, how much income do you have to spend? We'll come up with all of those things in the third leg of our core retirement design. So when you're done, you have a risk analysis, a tax analysis, and an income plan all put together for you, ready to go. And so that's really our core retirement design. Again, we want to help people have the retirement they always dreamed of. It's a simple phone call to get started. Give us a call at 863-877-1188. That's 863-877-1188 to schedule your 30-minute phone call. Or you can go to my website at statlerfinancial.com. There's a link there that you can click and schedule a time as well. I look forward to speaking to you soon.
And we will be right back, and we're going to be revealing specific strategies for building your volatility defense system and the critical mistakes that could leave you vulnerable when markets turn turbulent. The Statler Financial Radio Show will be right back.
Needing a second opinion on your retirement plan or to see if you're paying more than your fair share to Uncle Sam? Schedule your complimentary visit today. Text VISIT to 863-877-1188. That's VISIT to 863-877-1188.
The market goes up, it goes down, but retirement keeps going. And when you're close to retirement, those swings can feel very different. At Statler Financial Services, our planning focuses on helping plans stay aligned through market movement, so short-term volatility doesn't disrupt your long-term plans. It's about balance, income planning, and staying disciplined through changing markets. Call or text VISIT to 863-877-1188 now for your free risk analysis from Philip Statler at Statler Financial Services. If you're nearing retirement or already there, now's the time to review your strategy. Take the first step. Get your questions answered before the next market volatility takes a chunk out of your portfolio. Call or text VISIT to 863-877-1188. That's VISIT to 863-877-1188. Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Welcome back. It's the Statler Financial Radio Show. Let's get into the specific strategies that can help protect your portfolio and your sense of reassurance. Philip, what does a well-structured volatility defense system actually look like? It sounds so stealth or something, I don't know. And how can it help protect investors when markets become turbulent?
Well, I think one is, your core holdings need to kind of have some stability. So you've got a core portfolio that's going to kind of be the bread and butter that's going to be there, all the time. And then we have growth positions to help combat inflation. The one thing I know is as I talk to people all the time is, I don't want to be in the stock market. I'm going to tell you something. When I have 90-year-olds, that we have at least 10% of their portfolio is in the market. Why? Because it helps combat inflation. And we know inflation has been pretty bad here the last few years. And so this is one area that can help offset some of the inflation. And then having some protected income generation strategies. There are dividend portfolios that you can put together that would have some specific, allow you to throw off some specific amount of income. There are annuities out there that will give you an income stream for the rest of your life. And those can be beneficial. That way you don't have to worry about the ups and downs of the market. If they go down, it doesn't matter. Your income's not going to be affected. And then the last thing I think that people, I think they know they need to do it, but they want to retire early, so they don't care. And that is, folks, you need to optimize your Social Security benefits. You really need to do the math to figure out when is the best time for you to take Social Security. I understand if health is an issue and you need to retire at 62, But there's a lot of folks out there retiring at 62 or taking their Social Security at 62 and still working, that it is not a good idea to do that. And we need to look at why it's not a good idea. And we need to look at how can we do better and protect our spouse. And there's a lot of things that go into optimizing Social Security. It's not just the dollar amount that's there when you start drawing. And those are the things that we look at and talk about when we start talking about optimizing your Social Security benefits.
Now, there is a fascinating psychological component to market volatility. How can investors prepare themselves mentally and emotionally for the inevitable stress that comes along with the market downturns?
It's hard to really, kind of get that psychological component put together, because so many people live in fear. And so when the market starts to drop, they fear creeps in and starts to really take effect, right? So I think if we look at a couple of things, one is understanding your true risk tolerance before the crisis hits. Like I said earlier, people in 2008 found out they were not moderate investors too late after their accounts were already down 15, 20%. And so understanding what your true risk tolerance is before a crisis hits is a huge deal. It really, truly affects how you should be investing your money. Other thing is maintain historical perspective on the market recoveries. I mean, if you look back, I can go back to 2000, right? One of the first major bear market I went through as an advisor. And what we have seen both in 2000 and 2008, if you had a well-balanced portfolio, well-diversified portfolio, it basically took you 4 to 6 years to get back to even. And so you need to have that perspective on market recoveries. Now, we've had some, right? The COVID bear market was a flash in the pan. It was down 30%. In 6 weeks, we were back to where we were. So it does happen that way. Corrections, we have a 20% or 10% correction, and within a couple weeks we can be back up. So markets recover, and then we need to have a written plan, because that will help us reduce the emotional decision making that we're trying to do. Having that written plan that we can go back and look at is a huge deal. And then bucket planning, putting your different accounts in buckets. This is the bucket I'm going to draw from day 1 retirement until day 10 of retirement. Then I'm going to go to this bucket. So having the bucket approach can really help us plan out how we're going to use the income, and lets us put part of it, that last bucket we're not going to touch. If it has ups and downs, it doesn't really matter, because we don't plan on using that bucket anyway, except for emergencies and to leave to our beneficiaries. So that's part of the planning process there.
You said bucket planning. I thought we were adding to our bucket list. That meant. All right, let's address something that keeps many investors up at night: the fear that this time the market won't recover the way it has historically. So, Philip, how can investors balance learning from history with preparing for unprecedented events?
Well, I think that one thing, we diversify beyond traditional assets. If we look at some of the other models out there, when it comes to endowments and those type of things, how do they invest their money? They use some non-traditional assets to help when the market gets a little rough. Stress testing. I mentioned this earlier. Stress testing for various scenarios, taking your current portfolio and looking at what would have happened in 2008 if I had this current portfolio right now. Gives you some sense of okay, I can handle that, or no, I can't. We need to make changes. A big thing is this, Stephanie, you need to focus on what you can control. Tax strategies, Social Security optimizations, diversification, and then maintain flexibility to adapt. That's huge. We got to be flexible to be able to make changes. All of this wrapped up is our core retirement design. I'd love to sit down with you, talk to you about it, see if we can help you develop the retirement plan that's going to give you that retirement you always dreamed of. Give me a call at 863-877-1188, 863-877-1188.
And you can also text VISIT to that same number and contact Philip at Statler Financial Services, 863-877-1188, and get in for your complimentary visit. Now, we've covered a lot of ground today about preparing for market volatility. For listeners who are realizing they may not be as prepared as they should be, what kind of comprehensive portfolio review process do you use to address volatility vulnerabilities?
That's a lot of V's in.
There's a lot.
Yes. Again, the first component of our core retirement design is really identify and measuring the risk you have in your current portfolio. And that's going to give us, based on that number, we will know how volatile your portfolio could be. And so from there, we have kind of that view of here's what it looks like. Here's what it would look like in 2008. What do we want to do about it? Are you comfortable here? If not, here's some suggested changes we might want to make to make sure that we're okay on that front. It's planning. If you have a plan in place and the markets are going to go up and down, or maybe they go down and up, but they're going to be volatile. And if you're ready for that and you're mentally prepared for it, then you can weather those storms. And having that plan in place is a big part of it, Stephanie.
And, every investor situation is unique. We talk about that all the time on this show. So how can you create a customized volatility preparation strategies that align with each client's specific circumstances?
You're right. Everybody comes in with a different set of assets. They all have different goals. They have different concerns about what volatility looks like in their life. And so it is, again, and I feel like a broken record sometimes. It's putting together that plan, having that plan in place that will, really allow you to invest properly, understanding the amount of risk that you need to have in your portfolio to grow, but yet the amount of risk you need to be comfortable with. And I think that's really the bottom line is getting folks comfortable with the risk. And some people honestly never get comfortable with the risk. I can't tell you, I've got several clients that will say, I don't like the market. I know you do. I don't really necessarily like the market, but it's a tool that we need to use. And they trust that we are doing what's in their best interests, which is why we're meeting with them, why we're making changes to portfolios and making sure that they're in the best possible position they can be in. And that's all part of the process. You have to meet with people. You have to assess their fears, walk them through it so they understand where they are, and let them ask questions. And the questions they ask are huge, and being able to educate them on why it's important is a big part of what we do. And it's part of what we like to do, is we want our clients educated about why they are in wealth they're in, why we're using these tools in these certain ways to get them to where they need to be. And that's what it's all about, helping people be comfortable in retirement. I'd love to help you. Give us a call at 863-877-1188. That's 863-877-1188.
And that's what I love about you at Statler Financial, Philip. You let people go in, you talk to them, you don't talk at them, you help them understand, and if they have questions, you are happy to answer them. So please give him a call for a sit-down, a free consultation, 863-877-1188. And the Statler Financial Radio Show will be right back.
Many people don't plan for long-term care until they have to. But long-term care isn't just nursing homes. It can include in-home care, assisted living, or ongoing support over time, and those costs often aren't covered by Medicare. That's why Statler Financial Services helps clients plan ahead, looking at how long-term care fits into a broader retirement strategy. Planning ahead is not about expecting the worst, it's about understanding your options. Call Philip Statler at Statler Financial Services today at 863-877-1188. Philip and his team offer guidance to clarify your choices and cost before you need to act, no matter what life brings. Now is the time to learn more. Call Statler Financial at 863-877-1188, or you can text VISIT to 863-877-1188.
Advisory services offered through Second Half Financial Partners, LLC, a SEC registered investment advisor.
Welcome back to the Statler Financial Radio Show with founder and president Philip Statler. He owns Statler Financial Services. Philip gets questions each and every week about all things retirement. We are going to open up our Statler Financial mailbag right now and go over some common retirement questions. Let's go. Are you ready, Philip?
I think so. If you just don't hit me on the side of the head or don't throw me something that I'm not ready for. Make sure they're good, good dog bones that y'all throw me now.
I promise I'll be good. Here's our first question. Alex from Sebring. I bought a life insurance policy 20 years ago to help protect my family. Now the kids are grown and we're about to retire. Should I keep paying these premiums or just cancel the policy? I'm sure there's a lot of life insurance questions that you get from people.
We did get a few, not as many as you might think, though.
Right.
Most of the retirees, especially my older retirees, they've ditched their life insurance policies because they figure, they've got enough saved up. They don't need them anymore. Alex, here's what I would say. If, there's a couple things you could do. You could hand them off to your kids if there is any real value there as far as a death benefit. You could cash them in. That may be something to do too. You almost have to look at it and see, obviously the likelihood of you needing the death benefit is very small. And you don't want the death benefit to happen anyway. Right. So I would look at two options. One, what happens if I give it to the kids? Is it worth giving to the kids? Is it a big enough death benefit, a small enough premium that they can handle themselves and it would help their family? That would be one option. And the second option would be, hey, there's a cash value. I don't need it anymore. I don't need that death benefit anymore. So I could cash it in, take the cash. There may be some tax consequences, but if there are, they'd be very small, most likely. We'd have to look at the policy for sure to look to see how much you've paid in versus how much you're going to get. That would determine how much the tax would be, if any of it's taxable. I will tell you, I didn't do this exact same thing, but I did something similar to this recently. I had some interesting. I mean, I didn't even sell them to myself. I bought them from a friend of mine, but they were term life policies, but they increased annually, and they actually built up some cash value. Unusual, very unusual for a term policy to build up any kind of cash value, but these built up cash value. Heading into where we are age wise, and kids are gone and don't need anything for them. We decided it made sense just to cash them in. And so, we did, we didn't need that death benefit anymore. So we took the cash and added it to our savings account and just kept on rolling. So you really have to lay it all out and make sure that you're doing what's best for your family, Alex.
Nice answer. Very good. Very informative. Donna from Avon Park. We finally plan to retire this December. What happens if the stock market crashes right after we stop working? I worry about losing a big chunk of our savings right after the starting line. Yeah, that would not be fun. A lot of concerns for people just getting ready to retire.
That would definitely up your anxiety.
Yes.
Okay. Sorry. But that's why it's important that now, I mean, look, you're talking about December. That's not very far away. And the markets are still, have been somewhat high. It makes sense to have a plan in place. and to start with that plan, because that plan is going to take all the different options that are available and work through them to determine what makes the most sense for you. And part of it's going to be, how much do I need to pull out every month? Right? That's going to be a big deal. Um, and remember, if you listen to my show much at all, we talk about the first level of diversification is going to be what? How much goes in the safety buckets? How much goes in the growth buckets? That's going to be the first question that you need to ask yourself. Um, and so we need to be prepared for a market decline, given as long as this thing's been going up. But who knows? It could go up another 5 years. We don't know. That's the problem. And so we have to have a plan in place that's going to work no matter what happens. And that's where, to me, having the written retirement income plan in place will help you get through that and make sure that you can overcome that situation if it does happen.
You are listening to the Statler Financial Radio Show. You can give Philip Statler, president and founder of Statler Financial Services, a call at 863-877-1188. You can also text the word VISIT to that same number. Get your free complimentary consultation. Let me give it to you again, 863-877-1188. And Philip Statler is with us right now answering questions from listeners. And Bill from Lake Placid, I already have a financial advisor, but we mostly just review my investments once a year. If I come see you, how do I figure out if I actually need a new plan or if my current setup is fine? That is a good question. Very good question from Bill.
That is an absolutely good question. And my opinion, what you do is, hey, if you have a plan in place, bring it in. Let's look at your plan and see if it's going to do what you need it to do. That's what's going to make it work. And if not, if you don't have a written retirement income plan, that's your first step to knowing that something's not right, that you're not on the right path, because you don't have anything written that you can look at, that you can bring somebody else to double check to make sure that it's set up properly. So that's the first thing. So if you have that, bring it in. We'll look at it. We'll go over it together. We'll see if it matches up with what you want to have happen. If it doesn't, or you don't have a written retirement income plan that you can put your hands on and bring in, then number one, that tells you something. Number two, it means you need to actually build a plan. and we need to start from the ground up and build that plan to make sure that it's going to do what you want it to do. I mean, I think that probably answers your question. I'd love to sit down with you and help you out with that.
All right, I'll give him a call if you have any questions for Philip, brother. 863-877-1188. And we are doing the mailbag question. Stacy from Avon Park wants to know, most of our retirement money is sitting in a traditional IRA. We keep hearing we should convert to a Roth to avoid future taxes, but the tax bill today would be massive. How do we know if paying those taxes now is actually worth it for us in the long run? And I think it is worth it, right? That's just my opinion.
It depends. It's one of those it depends questions and answers. Everybody's different. Everybody's tax situation is different. And everybody's future is different. And so this is a case where planning really does help. And it may not be that it's for you, or maybe it's a portion of yours. So here's the one thing that people, I think, sometimes get confused about, is they think that it's a one and done deal. I got to convert all my IRA today to a Roth. And that is absolutely false. Okay. I have clients that we do $10,000, $15,000 a year. We'll convert it from their traditional IRA to their Roth. And it's taken us 5 years, and we finally have gotten, I think we got 1 or 2 more years left for most of them to get them all converted to their Roth IRAs. Now, the problem with that is we're going to get them all converted, and when he retires, he still has a big 401k that's going to roll out. So, but we've got a big chunk of it that's now going to be in the Roth IRA. And so that gives us options. And I love options, right? If I have options where I can take money from a non-retirement account or a traditional IRA account or a Roth account. Now, look, depending upon what's happening that year, I've got 3 different places I can pick to choose money and to live off of whatever those 3 things or a combination of those 3 things. So part of our process is a Roth plan, and whether that works for you or not, right? Here it is. We lay it out. Here are a couple different options you can do for Roths going forward. Just part of our process. We call our process a core retirement design. And that's really because we want to help you design the retirement you always dreamed of. We look at 3 key aspects within that, and that is risk. How much risk do you have in your portfolio? What should it be? And make sure it lines up. Taxes, because too many people are paying too much in taxes in retirement. And we set up and do some Roth conversion strategies to see if it makes sense. It does not make sense for everybody, but everybody should look at it to see if it makes sense for you. And then third is having an income plan. We need to have an income plan in place so that we know where our money's coming from and that we know that it's going to last our lifetime. Those are the 3 components that make up our core retirement design. Give us a call. We'd love to sit down with you, show you what that looks like for you, and put it in place. Our number to get started is 863-877-1188. It's 863-877-1188.
So I have noticed something, Philip. I've noticed we had more questions recently from women, and I love that they are aware of what's going on with their finances. Are you finding that women are more informed about their finances, more so maybe than 5 to 10 years ago, or even when you first started?
Yeah, it's still more heavily male dominated, but we are getting more and more women who are they're they're the financial bookkeepers of the family a lot of times.
Right.
And they may not be the investment person.
I see.
But when that happens, usually neither one of them really are the investment person, right? Is just out there and they're just watching it, not exactly knowing what to do.
Right. Kind of winging it.
Yeah.
Well, I think it's pretty important for women to be more informed or get themselves more informed with finances, don't you think?
Absolutely is, because statistically, your husband's going to pass away before you, which means it all drops in your lap if you're not the one that's used to dealing with it.
Right.
It can be overwhelming.
Very much so. And if you have questions for Philip, maybe you've lost a spouse, or you just want to find out more about your portfolio, maybe you're not married and you want to talk to Philip, you can give him a call. That number is 863-877-1188. The guys can call too, of course, 863-877-1188, or text visit to get a complimentary consultation. And please join us again next week. A lot of great information on today's show, Philip. Thank you for that. Join us again next week for the Statler Financial Radio Show. Have a great weekend, everybody.
Needing a second opinion on your retirement plan or to see if you're paying more than your fair share to Uncle Sam? Schedule your complimentary visit today. Text VISIT to 863-877-1188. That's VISIT to 863-877-1188.
Advisory services offered through Second Half Financial Partners, LLC, a SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Second Half Financial Partners, LLC does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation. This radio show is a paid placement.